Yeah.
Well, this year overall, I've seen commodities really left in the dust. You got equities, digital currencies really stealing the spotlight. Now, their record low valuations are screaming, buy me. Our next guest says this suggests a major extend for the bull market run starting in 2018. This is the S&P GSCI total return versus the S&P. Here is where you had commodities really outperforming during the Gulf crisis, during the oil embargo, the Gulf crisis, as well as the financial crisis, and now we're at record lows. Well, joining us now is the man who made that call, Shawn Hackett of Hackett Financial Advisors. President Shawn, why do you feel like it's a given and a screaming buy me?
Well, we look at all kinds of different asset classes, stocks, bonds, real estate, and we always look for these important valuation metrics that give us important turning points throughout history. As you correctly said on your chart, right now we haven't seen a low valuation of commodities like this since 1999 when we began the big bull market of the 2000s. So history doesn't always have to repeat, but it does rhyme very often, and we see no reason right now why commodities at this point and this valuation aren't going to outperform. And these cycles are long, by the way. These are like 10 to 15-year cycles. So we think that this is a place where a lot of money that's been parked in stocks or parked in Bitcoin, for example, or parked in real estate is going to start flowing into what's undervalued and what's starting to trend and outperform.
Shawn, do you need a catalyst for that, or do you think it's purely just going to be a value rotation?
Well, there's always a catalyst. The three catalysts we see during this cycle is the bull market and the U.S. dollar topping out, which we believe took place in January of 2016, and we've been basically under pressure ever since. That's the first precondition. The second precondition is there usually is some kind of a demand driver, a new demand driver that comes in. So we're agricultural specialists here at Hackett Financial Advisors, and what we see is China is really going after creating ethanol from corn. So if you remember back in the 2000s, it was the U.S. that was producing ethanol from corn, and it began a huge demand bulge for corn prices, which ran up corn and really got the grain markets going. We see the same thing happening in China with corn-based ethanol. And the third thing we see is there's something going on right now with what's called the grand solar cycle minimum. It's when the sun gets very quiet, you don't have a lot of sunspots. This has not happened in over 200 years. And throughout history, when the sun goes quiet with its sunspots, the weather gets very, very volatile, gets very it gets very abnormal, and we have tended to see significant hindrances to food production going forward, and we're just starting that cycle now. So the weather driver for agriculture over the next 5 to 10 years is going to be, a third main catalyst for why we think commodities are going to start to come off the bottom and outperform most other asset classes.
And you called me winter has come, nerdy. Exactly. And we're looking at solar sunspots.
Sunspots, okay. Way over my pay grade. So, Paul, I won't ask you about sunspots. Let me ask you about that chart and ask what about the commodity story are investors not getting? As Shawn just said, people have been really searching for yield. They're looking everywhere for yield. Why don't they see potential yield coming out of commodities, if that's right?
Well, remember that this is a relative value chart, so it's stocks, yes. It's commodities relative to stocks. So I think Shawn's right in terms that we probably will see a recycle. But I think the future is relatively bright. We've got strong growth almost everywhere in the world. We've got manufacturing booming around the world, and so the demand for commodities should be picking up.
So why isn't that? Sorry, go ahead.
I think the only shadow there is really China. And so it looks like, China was pedal to the metal, boosting GDP in the run-up to the 20th Party Congress in October. And now there's some signs that things are easing, right. Things are tightening a little bit. So that's maybe a shadow. Though in China at the moment, we've seen copper have an amazing run recently. And that's because the Chinese have been clamping down on pollution on some of the big copper producers.
But so why isn't any of this inflationary?
Well, the share of commodities that feeds through to what you and I buy is pretty small. Mm-hmm. It's not that big.
It's more labor.
Yeah, it's more labor.
Shawn, when you're taking a look at the best way to approach this kind of trade, I know that you're an ag guy, but is the value in the underlying commodity, is the value in the underlying stocks?
Well, we like to own the actual commodity in the beginning of the cycle. If you look at the history of performance, commodities themselves will outperform the stocks in the beginning of the cycle. And then once the trend is established and investors see the opportunity, they start flooding into the stock opportunity. So I think you play it two different ways. One is the commodities first and then the stocks later.
Shawn, really appreciate you joining us. Shawn Hackett of Hackett Advisors. Paul Mortimer-Lee of BNP Paribas is sticking with us. Coming up, strong holiday shopping season in the bag. What's next? This is Bloomberg.